Two, one. G'day, guys. Welcome back to Money in the Tank, episode 44. I've been back from my busy hiatus. We've got myself, Joel Seach, Principal Advisor, Harpel FG.
Yeah, and Arnie, finance professional. Good to be back.
We're missing you, Brad. Brad's overseas in Fiji at the moment. Just sent through some pictures to the group chat of the beach in Fiji, and we're incredibly jealous. But we miss you, Brad. We're thinking of you as we're slugging it out here. And we're in spring now. We're getting there. We're in some starting to get some nice weather and some nice Melbourne days, which is brilliant.
That's it, mate. Yeah. So today we're going to talk about Rifkin's rules firstly, but then we're going to just comment briefly on the Jackson Hole comments from Jay Powell and the Fed in America last week. And then Joel, you've got some market updates for us on how different asset classes are performing.
Yeah, we've got some slides to share. So if you're able to flick over to YouTube and watch us on YouTube, and while you're there, give us a subscribe and a like, and you'll be able to check out some of the slides we'll share today, which are quite interesting. Came across our desk the other day. And as always, everything is general in nature. So for educational purposes, and seek your own personal guidance for your own situation. So I've got a great 50-50 as well, because it's a footy themed 50-50 just around the corner. So I look forward to sharing that one with you guys too.
The D's, where you and me obviously thinking about the D's this weekend. So.
Absolutely. It's been a long wait. So we're looking forward to it getting to a game. So without further ado, here comes the Bible. So we're going to crack it open here, and we're at the chapter of Renee on success, page 73. So no person has ever been successful without the help of somebody else.
No person has ever been successful without the help of somebody else. Yeah, I mean, of course, mentors, parents, teachers, people in professional capacity, mates. So yeah, I agree with that, Rifkin.
I like it. And then the second one, you get 2 for 1 today, is if you wish to stay excited about life, don't stop learning.
I think that is so true. I feel like, you got to have passion for something, and you got to have your hobbies, and you got to have your interests. So
yeah, get that flame going and enjoy what you do. And life's too short to not. And if you're not learning, if you're not sort of progressing, you're going backwards. It's okay to stuff up and fail and mess up. But you're learning from those things, and that's what life's all about.
That's it, mate. That's it. If you that's I don't know if it's a fake quote or a real quote, but it's like you miss 100% of the shots you don't take.
Yeah,
is that Michael Jordan?
Probably Michael Jordan. Jordan one there.
Awesome quote. Anyway, I'll crack on with some comments about what like the Jackson Hole meeting and what Chairman Powell had to say. And Jay Powell. Interestingly, as Brad and I were speculating upon, he was very, very hawkish and has basically said that, like, just in a nutshell, they're basically saying that rate rises will continue until the end of 2023 at least, and they want to see more than 1 month inflation, coming down, because that's what we've seen so far. It's just 1 month of data of disinflation, and they want to see multiple months of that happening so they can come back to their inflation target of 2%. Because
for the listeners, Arnie, hawkish meaning from Jay Powell's perspective or the Fed Reserve's perspective?
Yeah, so when people speak about Federal Reserve meetings or speak, they typically categorize it as one of two things, hawkish or dovish. And dovish would mean that they are talking about loosening monetary policy, like a peaceful dove, and it's all going to be sweet, and money's going to flow into everyone's coffers, and it's no worries, and rates coming down. When they say hawkish, it's the opposite depiction of a predatory bird. They're being very tight with monetary policy. They are going to raise rates and try and be like tightening with the monetary policy, because that's what the Fed's all about. Like their whole remit is to bring price stability to their economy and have a strong labor market. And at the moment, America's labor market is very strong. Their unemployment is at like record lows, I think, or whatever. But as we know, in America and globally, inflation is raging. In some places, it's worse than America, but America's is quite high. So the tools that they're going to use to bring that price stability back down is mainly raising interest rates, and that's going to
one big lever.
That's their one big lever. Correct.
Their one big Jake lever.
They're one big Jake lever. Oh yeah, the footy reference in there. So I've got a few quotes here that Jay Powell pulled out of the meeting, where he basically said that there's going to be more pain to households between now and the end of 2023, and he said this is the cost. But he said that to not do so would bring far greater pain, which we've discussed before, which, he's alluding to hyperinflation. He said that in his opinion, he thinks the economy, the American economy has a strong underlying momentum, but he said it's out of balance. There's a high demand for workers than there is supply. Inflation's still raging, and they, at the most recent reading, they had a 2.5 to 2.5% target range for interest rates. but that's not a place to pause or stop. He did say that off the back of off the second 0.75 basis point increase, that the next meeting they're thinking about another large one, because it's not yet an appropriate time to slow the pace of increases. And he referred to the historical record of inflation and prematurely loosening monetary policy, and he was referring to the 70s and 80s, and ultimately Paul Volcker, the Fed chair, who raised interest rates close to 20% in America to basically strangle inflation. And he had to keep it high for a long period of time afterwards because of all the pain earlier where they had eased monetary policy too early, Jolie. So
yeah, and I think that on the back of maybe your podcast last week, and yes, I did listen. If you guys haven't tuned into that one, it's a ripper. In terms of talking about the risk factor, and a lot of the media you do see out there, the good media in terms of the people that have an idea of what's going on, is they do worry about the concern of if there's pressure on the Fed and they start to think that they've got it under control and they start reversing that tightening, and worst cases go back to easing of policy too early, can create long-term ramifications, as opposed to the old adage of short-term pain for long-term gain.
Yeah, well, he reiterated that at the last Federal Open Market Committee meeting that most members still saw their individual projections were slightly below 4% for the end of 2023, which means they've got another 1.5-ish basis points to go. Sorry, 1.5, 150 basis points. I mean, 1.5% to go before they get there. So if that occurs, we'll probably likely see rate rises flow through in Australia, as we've discussed many times previously now. Interestingly, we're seeing China cut their rates because they're obviously trying to stimulate their own economy a little bit with their own issues with the property market over there.
Yeah. And have you heard much about their lockdowns of China? I haven't read anything recently. Are they kind of given up on trying to lock down now? They're still
pursuing COVID zero. So when a large city gets over a certain point, I don't know what the markers or the threshold is, but they're trying to lock them down and get to COVID zero. And one other interesting point on rate rises is Italy in the Eurozone has been flagged. And you can actually go and look at a bloke called Sven Carlin on YouTube, SVEN, who did a video about this a couple of months ago. He was well ahead of the curve, but it's now circulating through news media, like financial news media, that if the central bank in Europe starts raising rates, or they have started raising rates, immediately coming from negative to positive rates has put enormous pressure on Italy and at risk of default. So they're probably going to have to raise rates higher to fight inflation over there too. And Italy is in a bad way. So I wonder what's going to happen over there with that country and other countries. So that's, in a nutshell, the main comments out of Jackson Hole and how it's going to flow through to us and other parts of the world.
Yeah, and there's that fine line with the employment thing. I think that, that there are people feeling the squeeze, and we've got really, really low unemployment at the moment, which, is good for people who have jobs and whatnot, but then it's potentially, creating this tightening of the economy as well, which is really hard to get labor. And essentially you end up, and I guess the easiest way to put it is to try to get something done like a shed at your home. 3 years ago, businesses are keen on your money and keen on your business and want to look after you and have the supply of the materials and the labor to get it done, whereas now they might have backlog and they might have a lack of staff, and they're sort of just picking and choosing which jobs they take on, which is not good for a free market economy. So essentially, they want to try to get that balance back right again, and start to hopefully get a bit of immigration to help with that job market and ease up the other side of the coin is they don't want it to happen too quickly. So that's why they raise rates, because they make it a little bit harder for those businesses and those companies to employ people, because the cost of running a business goes up a little bit. So that sort of then puts a little bit of ease back on the labour market too. And it's a fine line they're trying to balance, really.
Yeah, it's an interesting point. And I don't know what we're going to see out of it. Actually, someone was speculating to me earlier that countries like Italy, who are really, really struggling here, might try and follow a similar path to the UK and do like a Brexit or an Italy exit. I don't know what you're going to call it exit. But and if that starts to happen with a few of the countries, then I don't know. We'll see what the situation is in Europe. I don't know how likely or unlikely that is. I feel like sounds like it could be a very harmful thing. I think that's like, it sounds like not a good thing to me, but who
Well,
knows?
as from Italy as an economy, they've never been the most robust economy, have they? So,
But they've got a massive aging population as well, Joey. That's one of their major issues. Is like, their economy, like the people are really old, and like they're talking about having to get the oldies out of retirement to come back and work and stimulate the economy. And it's like, well,
and you worry about that, I guess, from if they do exit, to say whether they think. Sorry, I've got the printer going off in the background here.
Yeah, no worries.
So whether they think in terms of that's going to help as a band-aid fix, but then there's a long-term problem that I think we've spoken about on the pod before, and the old adage of the Eurozone, where the Germans, I think, were retiring at 65 and the Italians retiring at 50. So you're part of the same Eurozone where you're sort of coming together, that there's a big disconnect with what's going on in your country as opposed to another country. And that creates probably annoyances and spite amongst countries too, I believe.
Yeah, it would do.
So so interesting. That's that. And I think from an Australian standpoint, they mentioned that as well, with the old age population as one option, that to say, can they get a bit of the older age population that are keen to work but don't want to impact their Centrelink age pension? Can they do a bit of a buffer in terms of increasing that amount? Currently, I think it's about $8,000 a year that you're not assessed for from an income purpose for if you're over age pension age and doesn't impact your age pension. Could they potentially double that or increase that? That's something that's been put on the agenda too, just to help that short-term labour gap. So
I think that's like, I'm fully in support of that. Like I strongly believe that if you've worked your whole life and you want to retire, you should be able to do so and not work. But if you do want to work and you want to get out, you want to do so for your own mental health, physical health, and help the economy while you're at it, why not give better tax breaks and incentives to those people who are coming along to come out of retirement and help stimulate the economy?
And that, it's sort of like helping the economy, helping them, giving a bit of stimulation. And whilst the country needs it, it's not forever. It doesn't have to be forever, but in a period of time when, we're going through a very uncertain and crazy period, why not? And I think it's around 300 a fortnight they can earn currently without impacting their age pension. It's about 7-8 per annum. But if they can increase that or double that, and it allows those people to pick up those extra shifts at Bunnings or do whatever where there's some shortfall or gap, and they've got skill sets, really great skill sets. These mature age Australians, the amount of IP in those people would be huge. So
I know you said earlier that you got a footy 50-50, or I think you said you got a footy 50-50. What you just said has sparked, like, I want to come back to that and do that as an extra 50-50 at the end of the pod.
Okay,
as well.
Cool. We've sparked a 50-50 in Arnie's mind, so love that. Cool. So no, that's a great recap on Jackson Hole, Arn. And is there anything else before I share my screen as well?
No, those are the major points, mate. And it was a very, very short, sharp. It was like an 8-minute speech, whereas in past he's sort of gone on a bit longer and said broader things about the economy. What I will say is that in previous meetings, Powell has always sort of had, like, even though like they've had a consistently hawkish message saying they're going to tighten, they're going to keep it tight for a long time, he has sort of always thrown in a little bit of hope, like like the words like soft landing or threading the needle, or we're going to be data driven and dependent. This time he said none of that. There was nothing remotely dovish. It was pure hawkish, and I feel like the markets reacted to that, and I think they will. And then I will say for the tankers, the next Federal Open Market Committee meeting is 21st September in America. So that's when they'll announce if they're going to raise rates again, which it seems like they will. Another big one. So we'll see how the market reacts to that.
Yep. And our RBA meets next week, first Tuesday of every month. So keep an eye out for the RBA. Most predictions that it'll be another 50 basis point hike, taking our rate from, I think we're about 1 point. What are we now? 1.5-ish, 1.8. I should know that, but yeah.
I've forgotten to. I'll quickly Google it. Well, you get some of the asset classes and I'll have a look.
Yeah, love it. So, so keep an eye out for that, listeners. And I think the adage, Arnie, of under promise, over deliver is pretty spot on in terms of Powell's previous rhetoric, is that he doesn't want to sort of crash markets and cause huge worries. So he tends to sort of throw a little bit of hope in there.
Not this time.
No, but hopefully it's an under promise, over deliver. Yeah, what are the RBA rates at now? They're
current official cash rate 1.85%.
Yeah, 1.85. Yeah, so another 50 basis points hike can take us through to 2.35. So yeah, and I think there's some charts I'll show through in a minute with some of the expectations and predictions that people, some of the economists thought that
and tankers
might be coming up.
If you're on a variable rate and you have not yet done so, call your bank and see what the best deal they can give you is, because at the moment they're pretty keen to retain customers because a lot of people are moving. So if you haven't had a call with them recently and you want to ease some of that variable pain, give them a call.
Yeah, general in nature as always, but sometimes you've got to worry that the fixed term rates, potentially the run's been too late, but definitely look at adjusting and seeing if there's any room to move on your variables. But one of these slides actually does mention that, that there's already forecast for potentially an interest rate decrease by 2023, end of 2023, which would be fascinating, because I think that was when the first prediction was that the RBA was saying they were only going to start contemplating increasing rates then. So how the world changes. So these are just some interesting slides that I came across before. So unemployment rate, lowest in 48 years. So that's where Australia is sitting as a nation, and Victoria is right down the bottom there in unemployment rate. And 555,000 more people in work since the start of the pandemic, which is amazing with where people have been, I guess, picking up work now. This is the cumulative change in home value index since the start of the pandemic as well. So you can see a slight dip there, then a huge increase. Melbourne had steepest fall, so I won't worry about that one too much there. So this is the forecast of where the economists from the 20 leading economists think that the rates might get to. So that's where I read it this morning. Cash rate 1.85. So essentially, CBA have predicted by 2.6 by Feb, 3.35 by November, which seems a bit full on there for ANZ. 2.6. 4 for Vanguard, NAB 2.6 by Feb, all by Warren economists predicted a fourth straight 50 basis points increase at the next RBA board meeting. What do you think of that, Arnie?
That's interesting. I actually think that ANZ one that predicts 3.3 by November could be an interesting contrarian take that might prove correct, because I wonder if the RBA will say, rather than just keep raising them incrementally, let's just do one massive one, like a 1%, which won't bring us there, but it'll bring us a lot closer to that. I wonder if that will be the case. But anyway, like, I don't want that to happen personally, but from an overall economy and health of the economy perspective, that could be an interesting move by the RBA.
Yeah, and this is the ratio of housing debt to household disposable income. So it decreased during COVID and now kicked back up again. So it sort of decreased down and kicked back up, which puts pressure on affordability. And this is where I read before. So according to the RBA, the number of fixed-term loans increased by more than 50% between March and May of 21. And these loans now account for about 30% of total outstanding credit debt. So many of these will be coming off the fixed period of late 23, which obviously, may be a concern if they're currently insulated from the rate increases. So there's some interesting pros and cons with this whole slides, but this is sort of one of the ones, I guess, that I wanted to go through with the listeners out there. So if you are watching us on YouTube, then that'd be a great one to jump on and have a bit of a peek at these. And then in summary, there's a few slides at the bottom here. So it talks about Australia's population forecast to grow at one of the highest rates of all OECD nations. So it's talking about here, they expect New Zealand to grow at 6.3, Sweden at 6.1, and Australia sitting in there at 5.9. So interesting to see where the population to grow at one of the highest rates of all the nations there is over the next 5-year growth prediction, which is an interesting one that I was sort of keen to see where we're sitting now from a country of a country that's attractive to people coming through, or population just growing in general, I believe it would be as well.
I would like to know, I'll be interested to know the breakdown of how much of that is immigration versus how much of that is like a corona boom, like
absolutely
a corona baby boom.
Yeah, for sure. That'd be super interesting. So we'll see if we can try to find that for you guys. Residential vacancy rate. So Melbourne, and this is worse even in different states, and that's a big issue with if the immigration starts really ramping back up. There's already tightened rental supply at the moment in the market. So, we can see the vacancy rates starting to really get to a low point here, which puts pressures on rental rates and those prices increasing, and creates that issue that adds to inflation. So I think the pain's going to get worse in the rental market before it gets better. And I guess a side note is it seems the policy around that doesn't seem to be kind of helping where rental's going, because they're disincentivizing investors to, which is largely your mum and dad investors, to buy investment properties, because they're putting these different caveats in. There's a Queensland tax that I might cover on the next episode, which talks about their change to land tax, which is a big thing that would also put extra rental supply pressure on the Queensland economy, where they're already tight at the moment. So there's constant sort of issues that gets politicized around investment properties, and that's a supply of shelter for people, which is a necessity. And I do worry about that for people that are just going to be renters, and that's okay. But it puts a big strain on that. So since 1990, there's only been 5 periods where year-ended nominal home price growth has been negative. So there's only been 5 periods where it's been a negative period. And then this is historic capital city home price declines from peaks to trough, where they've declined. So ANZ predicting, a 17% fall, but the most we've seen was in 82 here, which was down at about -9.5. But we have a look back in 1819, it went down about -7. 2015, it went down about a -5. So interesting to see, in 2022, we can see up here with that little question mark there. So
gut feel, Jolly? Do you reckon it'll go 17%, or what do you think?
No, I don't think so. No, I think there's going to be too much demand, and I think you'll see it'll get darker before it gets lighter. So we'll probably have a bit more of a drop, but it's usually when it starts to get lighter is people sort of miss out and realize, in fact, they think it's still doom and gloom because that's what they talk about in the media. So, my guess is, it'll have a bit more of a pullback. But as the supply issues start to ease up and the demand starts to increase, and potentially when the interest rates start going the other way, the market will start pre-predicting those things. But and then you've got immigration. So you've got these, there's so many different levers that are changing to help a market, and every market's different too. So I think this is based on Melbourne particularly, but there's still markets out there that are increasing in value. So it's as we've said numerous times, every state is different, every territory is different, every region is different in Australia. So they'll all have their moments.
Interesting, mate. Very interesting.
Cool. So asset class wise, so I just wanted to go through this one with the listeners out there. So again, if you can get on YouTube, it's a great one. So the total returns percentage it talks about for the major asset classes for financial years ending 93 to 2022. So between 93 and 2022. So in the asset class legend at the bottom here, it explains the different asset classes. So you've got your Aussie shares, your bonds, your property, international, cash, US shares and whatnot. And then it talks about your best performers here each year and the worst performers here. Now tell me, Arnie, at the top of the line and the best, tell me one outlier you can see here.
Looks like Australian bonds, top line 2012.
You could be right. And tell me your second outlier.
Second outlier, gold, cash 2022.
So out of the 30 years there, almost 30 years we're looking at, bonds and cash were the best performers once, which is fascinating. And if there isn't a huge pattern here, but if we have a look kind of the middle line right across the midsection here, there's a bit more of the gold that comes down towards the bottom turn. And that's your risk return historic outcomes there. You can see the cash sitting predominantly down here. And then you've got a little bit more green sitting up in the top here as well. So just interesting to see different asset classes and how it's a bit of a patchwork quilt there in terms of the different winners each year, and they may not be the winners the next year.
That's very interesting. That's a very interesting chart, Jolly. I like that. I also wonder if they've accounted for foreign exchange when they're talking about international shares there. They must.
Well, they have a hedge down here and a hedged bond as well. So they've got international shares hedged and international bonds hedged, which is just meaning it's taking into account the dollar, hedging it. So so if there's a hedged version, which is helping with the dollar, then you've got a square outline there for that. So international shares hedged, you can see, was there. And then international shares unhedged was there.
Interesting.
So, so that was one of the graphs that I wanted to show, which a bit of a patchwork quilt. And the other one was a cool one that I came across, which talks about 92 through to 2022, so 30-year timeline. It has all the major assets, so US shares, Aussie shares, international shares, listed property, bonds, cash, and what CPI has done over that 30-year span there. And it talks about, it shows you on a big diagram here, the graphical format of the ups and downs over that period, and then the end outcome over here. But the cool thing that I noted that was really interesting that you get asked as an advisor all the time is, when's this volatility going to settle, and when's this going to change? And as you can see in these dot points here, that the one thing we can guarantee, and I'd guarantee this every day of the week, is there'll always be something that'll come up. There's always going to be a change. There's always going to be that worry. There's always going to be that political issue. There's going to be that war. There's going to be that crisis. Hopefully not a pandemic in our lifetime, but there could be a pandemic. So there's, as you can see from the dot points, the Asian currency crisis, the terrorist attack, the second Iraq war, the subprime, stimulus packages, oil spills, tsunami, Lehman Brothers collapse. What does that tell you, Arnie?
There's always going to be something happening in the market, mate, which is going to affect different parts of it. Yeah, you're spot on. And
absolutely.
One thing I might also say is you can have a look at the very top there, which is showing who was in charge of Australia and who was in charge of America at that time.
Yep.
And as you can see, it doesn't matter. Sometimes people worry about how a new party coming into power will affect their asset classes, but if you're just looking at the broad indexes or the broad categories overall, it's up and to the right. No matter who's in power, who's in leadership, they're all going for that same. They've all got that singular focus in mind, which is to sort of raise growth.
I remember around the Trump time, actually, which was interesting. This one here, so his time in reign was 17, roughly, it looks like, here to 2020. I remember at the time there was a lot of kind of, lead up, a lot of volatility in terms of the markets and what was going to happen and was he going to get in? And there was a big drop when he got in. And then he had this election speech that was quite good. And you can see the actual market during his period of time was quite good.
I also remember that little blip at the end of 2018 where that was a fair dip at the time in the markets. That was because of the perceived US-China trade war. So there's always something. They haven't got that dot point there, but
and every president or prime minister will claim, or Trump especially claims, that it's because he's in power as the market's done well. But really, I don't know how much it has to do with the person in power. But an interesting graph. So you look at all the little dot points there. You look at all the little blips of volatility. When you really dig into these graphs, you can see these blips. And these, as I should say, they don't feel like blips at the time. But when you zoom out and you look at a big map, they actually look like blips. And when you take that big perception over here, it's like a big undulating, ascending hill over time. So I thought I'd love to explain that to the listeners and talk about time in market and compounding outcome of return as opposed to timing the market, which is a different thing.
Fantastic chart, Joel. Yeah, and they always say timing the market will always beat timing the market. So that's just shown there. But I love that. That's great.
Yeah. So hopefully the listeners, if you can jump on YouTube and watch it, and while you're there, give us a like and a subscribe and write a comment what you think of the charts. And it'd be interested to hear your thoughts there and any questions you have or anything you want us to, to look up for you guys and give you some general information around charts. So feel free to shout out and check that out. And I think, if you check those visual aids out, it might be of interest to you for sure.
Good one, mate. Oh, well, that was a good wrap up. So what you've got a 50-50 and I've got one that was sparked earlier in my brain.
You fire your 50-50 away first and I'll put mute on because of the printer's going.
All right, cool. So the 50-50 that I got sparked in my brain earlier when you were talking about retirees entering the workforce, and you said, Jolie, at the time, maybe that'll be them going back to Bunnings. And I don't know why, but sometimes when I think of myself in retirement, I think, I could do a couple of days at Bunnings. And I wonder if every retiree feels like they're going to get like a part-time job at Bunnings. And then I started thinking about that movie American Beauty, where he goes back to burger flipping, and I'm like, what would you prefer to do as a part-time job if you were a retiree? Would you prefer to be working at Bunnings, or would you want to wind back the clock and be a burger flipper at Macca's? Which one would you rather?
I don't reckon Macca's would hire you.
Let's say they do in this scenario.
They do. I'll be keen on. I reckon I'll be keen on like a Bunnings or a hardware store. But my trade background skill set's probably not as adequate as yours, mate. You've done a year of trade, haven't you?
I did a few years of an apprenticeship, and then I did a few years in the fibre optics. So I would say overall, I've got about 5 years in the trades.
You've got a fair bit on me then, mate. So you'd be, if we were going in for the job interview at the same time, you'd get the job over me.
I don't know, mate. Well, you wouldn't have to worry about me because my choice is I think I'd like to go and do a bit of burger flipping because I never got to experience that kind of a part-time job when I was younger, and I wonder what it would be like. I'd probably hate it.
I didn't do the burger. I did the pulling beers at the golf club, so that was good fun, the private golf club. So if you did pulling beers, I'd be keen on that for sure.
You go back to bartending, eh? Well,
bartending.
All right.
The old uni job, mate, full circle, absolutely.
You
shout out to the golf club crew there, Al, Rhino, if you're listening. Shout out.
I having a chat with this bloke on the weekend at a pub, and he was running a thing called Melbourne Drinking History Tours, where they take you around to the most famous pubs and bars in Melbourne and like little like alleys, like little laneway spots. So that could also be a good gig as a retiree because you could have a few sippers on the way.
That's so cool. Love that. Love that. Great ones. And the 50-50 from mine with footy theme to it is we've got a Friday night game this week for Melbourne versus Swans, and Collingwood versus Geelong are playing a Saturday twilight. What would you prefer? Would you prefer a nighttime game? Would you prefer a daytime game?
Nighttime all the way, and I don't consider twilight a daytime game. So if you actually ask me, do I want a 2:20 start or a nighttime start? I'd probably maybe go 2:20. Do I want twilight like 4:40 or full on nighttime? Nighttime always. I hate twilight games. Get rid of them. Garbage.
Yeah, I'm a nighttime guy all the way. Love it. Love the nighttime games. So unless I'm taking the kids, and I probably prefer a daytime.
Yeah, then daytime. Good one, mate. That was good. That was a good one.
Right. All right, crew. Well, good luck to your footy team if you're playing this weekend. Bad
Go
luck
the D's.
for Carlton and Don supporters. You won't be part of it, but we'll be
rubbing it in.
We'll be thinking
Go D's.
All right, crew.
See you, mate.
See you all. Bye.